Well, stock buybacks are one of the most misunderstood financial strategies in the market. Politicians who love to use scary language call them corporate greed. But are they actually a long-term wealth building tool for shareholders? Today, we're going to separate fact from fiction and uncover why buybacks could be the smartest move a company can make.
Gary, thing number 5 this week, we're getting into stock buybacks. Focus today is going to be the benefits and misperceptions of stock buybacks. Gary, why don't you start by can you give us, a little bit of definition about stock buybacks?
So, Rob, what a stock buyback is simply when a company will go into the stock market, and just like you and I might buy shares in a company, the company will acquire its own shares and then retire them. And these efforts enrich all shareholders in proportion to the percentage of the shares outstanding they own. Because the shares are retired permanently, so they buy them back in the market and then retire them, buybacks are not, as many claim, a one-time benefit. Rather, they reduce the share count in perpetuity. So think about it. If, people talk about PE ratios, right? The price divided by the earnings per share, EPS, as you lower the share count, your earnings per share will go up. And that tends to make the stock go up. So when you reduce the share count, you will get higher earnings per share typically, and then you end up with more earnings growth. Stock buybacks are also more tax efficient than dividends because they allow shareholders to determine the timing of recognizing gains, and it allows them to pair gains with offsetting potential losses. You can take a short-term gain and turn it into a long-term gain. There are all kinds of things that shareholders can do to take advantage of stock buybacks that they can't do with dividends.
Gary, we've heard from politicians, people in the media, right, that stock buybacks only enrich company executives. Is that the truth?
Yeah, that is a lie. They love to use scary language. It's really fun to criticize management teams. And in fairness, yeah, there are some wealthy company managers who should be criticized, but not for this. There is this idea that they only enrich management. That is the biggest bunch of nonsense in the world. So if you own stock in a company and I own stock in the company and the CEO of a company owns stock in a company and they buy back those shares and retire them, then the share count goes down for all of us, assuming that they get good value and don't do something wrong with leverage. And we can go through some examples of how these things work, over the next few minutes. These buybacks enrich all shareholders in proportion to what they own. They do not benefit management at the expense of shareholders. They help everybody who owns the stock.
Gary, we want to talk a little bit too about examples. Obviously, there's, quite a different examples in terms of ways stock buybacks can work. I don't know how you want to tackle that, but tell us some of the best or worst, or kind of what you're looking for in those stock buybacks in terms of preferences.
All right. Let's break these stock buybacks down into 5 categories from best to worst. And we'll simplify all of it. So the best case scenario is management sees incredible growth opportunities and they invest in growing company operations. That's not a stock buyback. That's management saying, wow, we have incredible opportunities to reinvest in growing our operations. So not a stock buyback, where there's great growth available would be the best option. Second best option is where management thinks the stock is hugely undervalued relative to future growth, and they use their cash on hand to buy back stock. So they take their cash, which is not earning a high interest rate, and buy back stock that's undervalued. And in doing so, they create value for shareholders. We love that one. Next one down is management thinks the stock is hugely undervalued relative to future growth, similar to the one we just talked about. But instead of using cash on hand, they take on debt to buy back stock. So under the right circumstances, this kind of leverage can provide incredible benefits, but it does come with a lot more risk. Still can be a good option if management gets it right and they don't need to pay back the debt that they've taken on anytime soon. The next one, and this is not a good one, is when management makes an error in judgment and they buy back the stock ahead of declining or negative growth. When they do that, this destroys value. It is the same thing as if you or I were to make a mistake and buy a stock into declining growth and the stock goes down and we've just reduced the value of our portfolio. When management does this, it destroys value. We don't like that one. And then the worst possible scenario is management makes an error in judgment. They take on debt to buy the stock ahead of negative growth, and that can lead to bankruptcy. So there can be bad outcomes, but in general, stock buybacks are a vote of confidence by management in the company. And while a lot of the criticism of buybacks is inaccurate, what we recommend is making a careful evaluation on a case-by-case basis. What we've just done is given you 5 categories to use to think about this, to evaluate it. And so if you own a stock and management is buying back stock, try to figure out which of these 5 categories it falls into and whether it makes sense or not. But above all else, if you have bought and own a stock, why would you object to management buying the stock back, leaving you with a larger percentage ownership in an asset you already like?
Great stuff there, Gary, breaking that down for us. A kind of final point on tonight's 5 things, talking again about stock buybacks. How do you at DKI recommend people evaluate stock buybacks and when they're looking at that from an evaluation standpoint?
So generally, Rob, if I own a stock, it's because I think the outlook for the company is great and I think the stock is undervalued. If management is using cash on hand to buy back that stock, I feel like they're making the same decision that I'm making. And by definition, I like that kind of thinking, right? That's why I own the stock. So for something like that, I'd be very positive. The place where you want to be careful is if growth is slowing or has turned negative and management is taking on debt to buy back stock. And that's where you can end up in trouble. And in a situation like that, one, I'm hopefully not invested in a company like that. But if I am, that's where you start to look for signs of financial stress.
Great stuff, Gary. And that concludes this week's version of the 5 things. Again, be sure to subscribe. We'll be breaking everything down in the individual breakdowns. We'll get YouTube Shorts, TikTok, Instagram. I think we're starting to get that stuff in the pipeline out there. So wherever you are coming to us from or seeing us, thank you for your support as always. And be sure to subscribe to be notified about upcoming episodes and versions of the 5 things.